Okay, so in this lesson, we're going to be looking at the introduction to market structure. So we're going to be looking at the three directions that price moves in. We're also going to be reviewing trend lines and zones. What validates a trend line? How do you locate a zone? And the different trading types, such as day trading, scalping, and so on. To get started with, understand that the market is going to be moving in three directions. So when you are looking at price action, you are going to be looking to see if price is uptrending, if price is downtrending, or if it's consolidating. Now, you know price is uptrending if higher highs are being formed and higher lows are being formed. So price should be impulsing up, pulling back to make a higher low, impulsing up to break the previous high, pulling back to make a higher low. That's how you know if you're uptrending. And we are going to do live examples on the TradingView chart once we get into the advanced portion of market structure, but I just want you guys to have this foundation as the basis of understanding what we're going to be looking for when we get to the charts. And then as far as downtrending, it will be the opposite of an uptrend. So you should be impulsing down to make a low, pulling back, impulsing lower to break that previous low to make a lower low. So you should be making lower lows and lower highs when you're downtrending. And then consolidation is just when price is ranging between two areas. So there should be an area above where price is consistently rejecting off of, and then an area below where price is consistently rejecting off of. So we should have support and resistance at the top, support at the bottom, and price is basically ping-ponging between those two lines and staying in that zone. We're not making any new highs. We're not making any new lows. Price is just going back and forth in that area, and it's ranging, and that would be consolidation. The strategy that I will be teaching you guys is valid on every single time frame, but it is very imperative that it's layered on top of you understanding market structure. If you don't understand market structure, then you're not going to be able to apply the strategy. And we are going to have a practice assignment where you're able to really train your eyes to see market structure. Okay, next, when you are marking up your charts, you are going to be using trend lines and zones. That's how I'll be teaching you to do your top-down analysis. We are going to have a top-down analysis video where I actually show you on a live chart how to break down your chart from top to bottom. So trend lines are validated by 2 points. So as long as you have 2 points going in the same direction, then you have a trend line. So on the far left here, we have a downtrend, and we know it's a downtrend because we see these lows keep getting taken out. We keep making lower lows and lower lows and lower lows, and price is pulling back, but it's still making lower highs and lower highs and lower highs. So that's how we know price is downtrending. And as long as price is respecting this trend line, we know that we're in a downtrend. And right beside it, we have the complete opposite. We have an uptrend. So we have those 2 points, and those 2 red dots are the 2 points which validate the trend line. And with this trend uptrending, we have an impulse up, a pullback to make a higher low, an impulse up, a pullback to make a higher low. And we have that all the way until that trend line is broken, which means price crosses the trend line in the opposite direction and it breaks structure, or it makes a new low or a new high, depending on the direction that it was going. All right, and then we have our zones. Zones are, they're actually very easy to locate once you've been looking at the market, but it's basically an area where price is constantly reacting off this area. So you will see constant rejection, as you can see here in these pictures. And like I said, we are going to be going to the chart to look at live examples of this. Right now, we're just getting the basis and understanding of what we will be looking for once we get to the charts. So a zone is where price is consistently reacting. So we see price coming up to this zone, rejecting. Price is coming up to the zone, rejecting. Price broke through the zone, came right back to the zone, rejected. Came right back to the zone again, rejected. So that is what you're going to be looking for, is an area of price. So when price gets into this area or price gets into this range, we know there is going to be a reaction, because every time price comes to the zone, reaction happens. And I am being repetitive in these videos because, number one, repetition is the best way to learn. And number two, I want to make sure that you understand each of these pieces that we're putting together is what's going to allow you to become successful when it comes to reading the markets, applying your strategy, and collecting your pips and collecting your profits from the market. Trading is tailor-made for each person. You when you come into this trading space, you are going to be trading at the times that work for you. You're going to be trading the pairs that work for you, and that is going to be involved with your trading style. So there's scalpers, there's day traders, there's intraday traders, and there's swing traders. And we are going to look at a few trade examples so you can understand the difference between. Because really and truly, when it comes to choosing your trading style, that's going to be based off your emotional personality. If you are more of an impatient person, or if you are a busier person, that's going to determine whether you can sit in a trade for a long period of time, or if you prefer shorter trades. So let's start with the scalpers. So this is an example of a scalp position. The trade actually lasted 30 minutes. Now let me make a disclaimer. These are not actual trades that were taken, nor are these trades setups that I'm saying you should be taking. These are just examples so you can see how long each position size normally would take and what the pips would look like in that time frame. So for the scalp position here, this trade lasted 30 minutes and 13 pips were collected. Then in the middle here, we have an intraday trade, which lasted 2 days. So intraday traders, it's a little different than day trading, but they may hold the trade basically another day or two past the entry. Now, with this intraday trade, this lasted 2 days, and it was 163 pips that were collected. And then for the swing trade here, swing traders can last days, weeks, months, depending on, what they're looking at for their position. So with this swing trade, this lasted 15 days and 421 pips were collected. As you can see, the most drastic difference in here is as the time is extending, that's the more pips that you're collecting. Now, as we know, your lot size and your position size is obviously going to be based on your account. So you're always going to be using risk management. Proper risk management is risking 1 to 3% of your account. Do with that information as you will. So when it comes to scalping, normally your lot size and your position size would be higher because you are risking a less amount of pips. You are collecting a less amount of pips. So you want your position size and your lot size to be a little heavier so that you're still able to hit your target goals. Now, when it comes to intraday or day trading, that is more of a middle ground. So you don't have to go as heavy on the lot or position size because you are collecting more pips. And then when you're swing trading, typically swing traders use a lower lot and position size because they're in the trades for so long and they are collecting more pips. So this will always be your risk. What your lot and position size will always be based on your own personal account. You should not be looking at anyone else's trade and you see that they're placing a standard, so you place a standard, or they're placing a 0.01, so you place a 0.01. No, you should only be focused on your account size, your trade side. When they told you in school, keep your eyes on your own paper, trading is the number one place where you need to keep your eyes on your own paper. Do not risk in the way in which other people are risking because you don't know their account size. So that's going to be it for this lesson. Stay tuned for the next one.